Why you should get really excited about losing a bunch of money on real estate. Let's get into it and talk about it. Welcome everyone. Thanks so much for joining me. If you're new here or if you haven't done so yet, make sure to hit the subscribe button right down below the video, as I'm back each and every day in videos just like this one to help you out in any way that I can through these ideas and concepts that I share right here in these videos. So thanks again, subscribe down below, and let's get into it and talk about why it is super cool to lose a bunch of money on real estate. Paper losses, that is, right? Not real losses, but rather losses on paper. All right, let's get into this, but really quickly before we do, I have to preface this video by saying this is not advice in any way. It's not financial advice, it's not investment advice, it is not tax, accounting, or advice in any way, shape, or form, but rather it is just me with some talking points, and hopefully it gives you some ideas and better understandings about why it is actually incredibly advantageous to lose money on real estate. And again, paper losses, not real losses. All right, so let's get into this and talk about it. So one more thing, when I refer to real estate, I am talking about investment properties, rental properties, investment grade property. I am not talking about your primary residence. So if you think I'm talking about your primary residence as in your home, no, I am not talking about your primary residence, not your home. We are talking about investment properties. Maybe things like an apartment building, maybe a mall, maybe a single family home, condo, townhouse, duplex, apartment building, triplex, things like this. This is what we are referring to in this video. So now that we have that clear, let's talk about it a little bit further. One other misunderstanding that most people don't recognize who own these types of properties, that it is a business. Most people just say, yeah, I just own a rental property. I have a house, I rent it out, and I just kind of do that thing. Well, guess what? If you own that type of property, you are a business owner. You have a business. Rental real estate, whether it is one property, whether it's 1,000 properties, or whether it's 10,000 properties, it does not matter one bit. You have a business. Rental real estate is a business. Regardless of what it is. It could be one house that you have one tenant in. It could be a mall that has 50 tenants that are all merchants, stores, things like this. It doesn't matter. If you own any of that, it is still operated as a business, which is actually really cool about it, because here's the thing. Rental real estate, you operate it as a business. Therefore, you have income coming in, rents received, and you also have expenses. So as you operate your rental business like a real business, you have your income, you minus off all your expenses, and then you have maybe a profit left over at the end of the day. Maybe, but in most cases, on most people who own rental real estate, you will not have a gain at the end of the year, simply because of all the expenses that you have within your property. So one more thing that we need to recognize and understand. Again, if you own this type of property, you probably already know this, but there are a lot of expenses associated with owning a property, right? So you have insurance on the property, you have property taxes, you have upkeep, maintenance, and repairs, you have management, you maybe have commissions if you hire somebody to find you tenants, you have all kinds of things, you have utility bills, you have literally, the list goes on and on. You have cleaning, you have all kinds of stuff, legal expenses, professional expenses, literally, expenses all over the place. You have mileage because you're driving back and forth from the property, just literally all kinds of stuff that are associated with that property. So as you can see, it's a real life business, right? It is a real thing where you have a lot of expenses associated with that property just to keep it up. And then you take all those expenses and you apply them against all of your rents received. So on top of that, there's another cool expense at the end of the year, which again, you'd probably want to talk to your accountant about, because it can be a little bit tricky kind of calculating this out. And a lot of times they use their sophisticated software to figure out what it should actually be for the year. But it is something called depreciation. Now again, you probably recognize what this is, but depreciation is also called a phantom loss, right? So if you ever heard about this, it's basically the exact same thing, but basically it is a loss on paper, but yet it's not a real loss that comes out of your pocket, right? So this is what allows somebody who owns rental real estate to show a loss on paper, not a real loss, but a loss on paper, as a phantom loss, as in because of depreciation, right? So Let's talk about a couple examples here, and then we'll discuss why it is actually cool to lose money on rental real estate. Again, not advice, but rather just some things to talk about and some things to consider and things that you should probably be taking into consideration when looking at your rental business, right? So let's give you a quick example. So you own a property, and let's just say it's a single family home, and you have one tenant in there that pays you $1,000 each and every month in rents received, right? So that person cuts you a check every single month. They give you $1,000. Now, through all of your expenses that you have on the property, maybe a mortgage, maybe utilities, property taxes, insurance, interest, principal on your mortgage, what else? Insurance, all kinds of things you have on this property. Let's just say that you have a total out-of-pocket expense of, let's just say $900, okay? So you cash flow with a positive cash flow of $100 every single month. You have $1,000 coming in, you have $900 going out the door, you positively cash flow $100 every single month. So you have a positive cash flow of $1,200 every single year. Well, okay, it shouldn't be that hard to offset $1,200 of income, right? So you have $1,200 of positive cash flow, therefore net income on the property at the end of the year. It looks like you're going to have to pay taxes on that $1,200, right? Yeah, bummer. Yeah, that's too bad, isn't it? Well, not so fast. Now you get to come in and apply depreciation on top of everything. Typically, depreciation is the last thing that is calculated and added onto the equation. So typically, you take all of your gross revenues, as in your gross rents received, you take that, you minus off all of your expenses, whatever your expenses are. Now, for the most part, you do get to write off the vast majority of your expenses in your first year. However, there are some expenses out there that may need to be depreciated over a few years. Again, talk to your accountant about that. I'm not your accountant. I don't know your situation and the exact parameters of your property, but your accountant should know the answer there. You may need to depreciate some of these expenses, but for the most part, the vast majority of expenses get to be written off the same year that they were incurred. So you write off all of your expenses. Then you take your income down to whatever it comes down to. It could be $5, it could be $5,000, it could be negative, whatever it happens to be. And then on top of that, you pile on the depreciation. Now, when it comes to residential real estate, you get to depreciate your property over 27 and a half years. So here's how this works out. If you own a property, for example, that single family home that we talked about, let's just say that it has a market value of $100,000. Or what I should say is you bought it. You bought it for $100,000. You can depreciate the building, right? So like the house, but you cannot depreciate the land. Typically, the land runs anywhere between about 15 and 20% of the purchase price. So if you bought the house and the land, of course, you bought the entire property for $100,000, generally, you're probably going to allocate anywhere between about $15,000 to $20,000 of the purchase price toward the value of the land. That's just generally like the rule of thumb is anywhere between about 15% and 20% of the purchase price goes toward the value of the land. Okay, so let's just say it's 20%, just for easy round numbers. Let's just say you allocate 20%. Therefore, $20,000 of the purchase price goes toward the value of the land. Therefore, you have $80,000 that you get to depreciate over 27 and a half years. Now, of course, I would highly advise that you talk to your accountant about this because there are some weird rules about this, how you calculate depreciation, especially if it's your first year and you have a half year and you have days, months, things like this. There's a certain calculation you need to run in order to figure out your depreciation for the year. So either way, you take that 80 grand and you get to depreciate that out over 27 and a half years. Now, I did not run the calculation on that, but whatever that comes out to, so you basically divide it all out. And of course, if there's partial years and months and stuff in there, that adds a little bit of complications to the calculation. But whatever it comes out to, let's just say it's really rough math. I'm just going to say it's $2,500 a year, just really roughly. I think it's about $2,500 a year. So of course, that's really rough, but let's just say it's $2,500 a year. So that is extra phantom loss that you get to write off against your property above and beyond all of your other expenses. So let's go back to our original example. We said that you had a tenant in your property that pays you $1,000 each and every month. You have $12,000 of rents received on an annual basis, right? But remember our example, you cash flow $100 each and every month. Therefore, a net income of $100 of positive cash flow over the course of the entire month, therefore $1,200 for the entire year. Okay, so you have positive income, right? You have income of the property, off the property, of $1,200 from that year. Okay, so now you're sitting with a $1,200 gain that you may need to pay taxes on. Uh-oh, nobody likes paying taxes, right? So, therefore, you get to apply your depreciation. Remember, it's about $2,500 in the case that we're talking about right here. And again, it's going to vary every single property in every situation. So, again, talk to your accountant about that. But now you're posting a gain of $1,200. You apply your $2,500 of depreciation, boom, there you go. Now you're negative. You've just lost $1,300 in this year because of depreciation and all of your expenses. So therefore, you actually had a $1,200 gain on that property that you stuck right in your pocket, but yet on paper, you just lost $1,300, right? So you have a $1,200 gain minus the $2,500 of depreciation, which brings you negative by $1,300. Pretty cool, right? So there you go. You have just lost $1,300 on paper. Not in real life, but on paper, right? So this is another way why rental real estate is so incredibly powerful, because you can actually have a positive cash flow. You can actually make money on real estate every single year. And then with the power of depreciation, you can actually take your gains, wipe them all out, all the way down to zero or even negative, like this example that we just talked about right here, right? So is that not cool or what? So now tell me, is it cool to lose money on real estate? I don't know about you, but it's pretty cool to lose money on real estate, right? But again, I want to make this very clear. This is specifically talking about investment grade property, right? Investment properties, rental real estate, things like this. Houses, single family homes, duplex, triplex, fourplex, apartment buildings, strip malls, literally, you name it, things like this that you can rent out and operate as a business. We're not talking about your primary residence. No, you don't want to go sell your primary residence for a $50,000 loss and be like, hey, I just lost 50 grand. This is awesome, right? No, that'd be bad. That'd be a real loss then. No, we want to talk about paper losses. How can you get paper losses, right? That's what we want to talk about. So anyway, hope this helps you out. I hope it gets you thinking a little bit. I hope it gives you some more ideas and shows you once again the power behind rental real estate and why it can actually be a really cool thing. But again, I would say go out and do some more research on this. Learn as much as you possibly can about real estate before you just jump into the game, because there's actually a lot you need to know. So either way, subscribe down below. I love talking about topics like this, and I want to do whatever I can to help you out through these times and hopefully share some ideas and concepts with you that, of course, get you thinking and ultimately get more money in your pocket. So thanks again for your support. I really appreciate it. Subscribe down below, share the video with your friends, family, social media, and go back and check out some other videos right here on the channel. Thank you.